Today on Open Exam Prep, we're tackling money market instruments, a key topic on the Securities Industry Essentials or SIE exam. These are not stocks or long-term bonds. Instead, think of the money market as a place where large institutions park their cash for short periods. The defining characteristics of these instruments, which you absolutely must know for the test, are their short-term nature, high credit quality, and high liquidity. They all mature in 1 year or less, making them very safe, cash-like investments. Let's start with commercial paper. This is essentially a short-term, unsecured IOU issued by large creditworthy corporations. Imagine a company like Apple or Microsoft needs to cover payroll for a few months before a big revenue influx. Instead of taking out a traditional bank loan, it might issue commercial paper. The most critical detail for the SIE exam is its maturity. Commercial paper is typically issued with maturities of 270 days or less. This specific number is chosen to exempt the issuance from SEC registration requirements, making it a faster and cheaper way for a corporation to raise short-term funds. An exam question might ask what instrument a corporation would use for short-term financing while avoiding SEC registration. The answer is commercial paper. The trap here is to forget that it's unsecured, meaning it's only backed by the corporation's good faith and credit. Next, we have bankers' acceptances, or BAs. Whenever you see the term bankers' acceptance on the exam, your brain should immediately scream international trade. A BA is a time draft, like a post-dated check, that has been guaranteed by a bank. It's used to facilitate import and export transactions between two parties that may not know or trust each other. For example, a U.S. company wants to buy electronics from a South Korean supplier. The supplier is worried about getting paid. To solve this, the U.S. company's bank can accept the time draft, guaranteeing payment on a future date. This acceptance creates a negotiable instrument that the supplier can either hold until maturity or sell at a discount to get cash immediately. For the SIE, know that BAs are used for import-export financing and typically have maturities of 180 days or less. Finally, let's discuss repurchase agreements, commonly known as repos. A repo is a transaction where a firm sells securities to another firm with a promise to buy them back at a later date, usually the next day, at a slightly higher price. The securities act as collateral for what is essentially a short-term loan. The difference between the sale price and the repurchase price is the interest on the loan. The SIE exam will test your understanding of who is the borrower and who is the lender. The firm selling the securities and agreeing to buy them back is the one borrowing the money. The firm buying the securities is the one lending the money. A common trap is the reverse repo, which is simply the other side of the same transaction. If Party A is doing a repo with Party B, then Party B is doing a reverse repo with Party A. The primary risk associated with repos is counterparty risk, the risk that the other party might fail to fulfill its end of the deal. To keep these straight, use this mental shortcut. Think of the money market as the corporate world's wallet. When a corporation needs quick cash, it uses commercial paper. When you need to finance border-crossing trade, a bank guarantees it with a banker's acceptance. And for a really short-term, overnight loan, institutions use repos. CP for corporations, BA for borders, and repos for really short-term. Understanding these distinctions is crucial for passing the SIE.